So a recession is just over the horizon. At least that's what everyone else is saying. In today's episode, I'm going to show you why we may not be heading towards a recession after all, or a big market crash for that matter. But it'll come at a price, a very hefty and inflated price, because we might be trading in a recession for inflation. Before we get started though, nothing in this video is financial advice. This is just my opinion. All right, let's dive in. This is an interesting chart that I found on Twitter, and we're basically looking at all of the biggest loss leaders coming off the last mania, the last bull market of 2021. Carvana, all the way down to Tesla. You can see Tesla down 72% from its peak, Spotify down 80%, all the way up to Carvana down 99% from its peak in 2021. Now, this chart really piqued my interest because all of these companies are a byproduct of cheap capital. Cheap capital in the form of 0% interest rates, artificially low interest rates, which elicit more malinvestment into the system, into the economy. Now, would all of these companies have existed in a non-zero interest rate environment? Who knows? But I'd wager to say we could probably take off a few names from this list if we had interest rates, anywhere near what we have now, which really isn't that aggressive, to be honest. Inflation's running at 6.9% annualized, and our interest rates are what, 4%? It's still a negative real rate. So, all right, we've looked at the chart and we've seen that we've had a pretty big correction in a lot of these unprofitable growth tech stocks. But does that really mean that the recession has bottomed? Well, let's take a look at this other chart. This is recession expectations, and everything here in blue, in dark blue, tells us that 80% of people in the market believe that we are heading towards a recession. Now, the last time we were anywhere close to these levels was April of 2020 and March of 2009. And in both cases, we saw that as the bottoming. When everyone pricing in a recession, again, it's the same principles that we have when we buy a stock or an asset. If everyone's talking about, the allure, the interest in your tech stock of the day, your cryptocurrency of the day, when your hairstylist or your taxi cab driver or your Uber driver, whatever, you're the store clerk at your local grocery store, when everyone thinks the same way, then that pretty much means that there's no more capital to be positioned in that direction. And it's the same thing on the other side. When everyone thinks that there's a recession, and as we'll see here next, there's plenty of cash positioning for a recession. Actually, there's more checkable deposits now than at any point in history. We're sitting at about $5 trillion of checkable deposits in people's bank accounts. So that money is just sitting on the side, waiting to be let loose, waiting to for some sort of signal that happy days are here again. Because again, everyone believes that we're in a recession. And when everyone believes that we're in a recession, then they're going to put money to the side. They're not going to spend money. And what happens when you don't spend money? Inflation starts to cool down, which is what we've been seeing in the last few months now. Inflation has kind of started to cool its rate of growth. But once more and more people begin to realize that maybe pricing in a recession isn't all too certain, a lot of people are going to spend their capital. And that expansion of velocity and money velocity will drive inflation even higher. Now, speaking of inflation, this is another interesting chart. This is from this is looking at the core CPI here in dark blue over time, and then you've got these dashed red lines here as well, which denote survey professional forecasters. So these are forecasts from prior time periods. So you can see that even all the way back when inflation really started to kick in the summer of 2021, we had forecasters predicting a return to 2% within the matter of a few months. It's nuts. And it's not only then, it's always, forecasters are always predicting consistently, at least within the last 2 or 3 years, that we're going to see a return to 2% inflation year over year. Now, this light blue line here is Bank of America's current forecast. And again, keeping in line with prior predictions, they're predicting a downturn in inflation growth. Now, does that necessarily mean that they're wrong? Not necessarily, but it's always interesting to see the people that are wrong the most often, the inflation is transitory crowd, continue to have credibility in our space, in the investing space. So why is that? Well, it's because most institutional investors, most of these big name players in the market aren't invested in what we're invested in, which is commodities and energy. We as viewers of this channel, this is what I believe are the next big asset classes heading out until probably the next decade, who knows. But in this chart here, this shows cross asset class performance year to date here in 2022. And anything here in red means that it's lost money on a year to date basis. And pretty much the only assets that have made money in 2022, other than the dollar compared to other currencies through the DXY here, which is only up 8.6%. All of these other big bars that we see on the right-hand side, that's your commodity sector. So when commodities go up, inflation goes up. You've got, when the price of the materials needed to create your goods goes up, then you're going to have higher prices downstream. And this is why, another reason why I believe that inflation is secular. It's not going away, anytime soon. The days of 2% growth, 2% inflation, annualized growth, that's a different world. We are in a different world today than we were back then. That's just my opinion. I could be wrong. Who knows? But to cap things off, I want to look at this tweet from Josh Young. And he basically shows that since China reopened, which has only been, a week or two now? Maybe a little under a couple of weeks? We've seen oil imports jump 650,000 barrels a day. That pretty much offsets what we're releasing through the United States Strategic Petroleum Reserve. And oil is everything. Inflation is downstream of the oil price, essentially. You need oil to transfer your goods. You need oil to manufacture goods like carpets and pharmaceuticals and all this other jazz. You need oil for energy, obviously. You need oil to extract the rest of the commodity class. How are you going to mine for gold or copper or silver or any of these assets without oil for your bulldozers and heavy machinery? So, guys, we've seen everyone jumping on the inflation boat. But now we've also seen everyone jumping on the recession boat as well. And what I'm seeing is that there's not too many voices on the other side. Everyone's calling for a recession, a crash. Go talk to your family members. Go talk to your friends who aren't deeply ingrained in this kind of information, in this kind of stuff that like we are. The average Joe believes that we're heading into a recession. So that kind of mindset elicits a tightening in savings. Again, all that cash on the sideline. And yesterday, in yesterday's episode, we looked at the put to call ratio. There's more downside betting on the S&P than any other time in the last 10 years. All it takes is a small rally to unwind that entire thing and create a short squeeze. So that's what I got for you today, guys. If you like this content, go ahead and subscribe. If you enjoyed this video, go ahead and like it. And I'd like to hear your comments. Do you feel like, have I changed your mind on a recession? Have I changed your mind on the inevitability of a recession? Or could we have both? Could we have a recession and inflation? Could it just be a stagflationary environment like we had in the 1970s? I'd really like to see your comments below, your thoughts as well. So until next time, guys, see ya.